My name is Greg Michaelowski. I'm with FXDD and I'm doing a Forex commentary for FX Street. Well, today we did have better industrial production capacity utilization out of the U.S. And that spurred a short covering or flight into the risk currency pairs, which had previously been looking a little bit under pressure. We'll start off by taking a look at the dollar versus Canada. And earlier today, the market had actually moved above the 100-hour moving average. That 100-hour moving average comes in at 103.06. That's this blue line in this chart. You can see the market has been below that moving average ever since this point right here at the 105.02 level. So a good move to the downside over the last 5 or so days. But we did find some support yesterday against the prior low, and today we found a double bottom here at the yesterday's low, and that helped spur some short covering rally in the dollar versus Canada, some weakness in the Canadian dollar that pushed the market back above the 100-hour moving average. But once the data came out, I'll zoom in here, the market then started to use that 100-hour moving average as a level of resistance, 103.06, and the market starts to move back to the downside. Now we do have support down here at the 102.41, and we have seen some buyers coming in. This low came down to 102.55. But as long as the price can remain below the 100-hour moving average, currently at 103.03, the buy is going to mean the downside for the dollar versus Canada. Let's take a look at the Aussie versus US dollar, and this is another currency pair that had looks of perhaps moving down here today. The market broke through this trend line. You can see a number of different points along that trend line that held yesterday. We actually dipped below that level, but then we found support against this this high from June 10th. The market, when it was able to hold that support, moved back above the trend line, back reestablishing it as a key support level. And then today, if I zoom in here, you can see that we had a number of different bars that held that level, and the market started to break down below. We did find support against the 85.86 level, and then we had the better data, and the market is now back up, testing the bottom end of this trend line at the 33 level. We reached a high of 30.39, but the market has since started to move back down, currently trading 86.25. So we'll reestablish this trend line resistance at the 32 level. If the market is able to hold below that level, and we may find some profit takers against the level, then we should see some further moves to the downside in the Aussie versus US dollar on this break. But we're going to have to get through this 86 level, and if we do that, we should head down toward this 100-hour moving average. That 100-hour moving average currently comes in at the 85.54 level. Alternatively, if the market is able to break above the 32 level, we should head up and test the highs. The highs here at 86.66 for the Aussie versus US dollar, and could see further moves to the upside with the potential for the contract to move toward the 87.27 level, which is the midpoint of this move down from the April 12th high down to the May 25th low. Again, the 50% comes in at 87.27. Let's take a look at the New Zealand versus dollar. This currency pair is bumping against the 100-day moving average. I wrote and talked about this in yesterday's commentary on FX Street. You can see how 2 days ago the market moved above that 100-day moving average for the first time since this level point right here back in May, but that was quickly rejected given that big tail. Yesterday the market had a lower low, but moved back up toward that 100-day moving average. Today we had a similar high, market staying below that 100-day moving average. That level comes in at 69.99, and is going to be the key level to watch here for the New Zealand versus US dollar. Taking a look at the hourly chart, the bias on this hourly chart remains positive, as the market has been able to stay above the 100-hour moving average. The 100-hour moving average comes in at 69.15. As you can see, that we've been above that level since 66.85 here. The market originally moved above, went up to test a 200-hour moving average. That's the green line of the chart, then moved back down, and then starts to move back to the upside, and that caused momentum. Now, over the last couple of days, we have broken this trend line, and we could possibly also move this trend line over to this area right here, and we've also broken that. We're testing the upper side of it at 69.71. The market currently trading at 65. Maybe if we break above that 71 level, we could see higher prices in the New Zealand versus U.S. dollar. But this is a consolidated pattern, I guess, here, given the mixed data that came out with the weaker housing data earlier today and the stronger industrial production. 69.15 is again that 100-hour moving average in the New Zealand versus U.S. dollar. If we break through that level, we could see further corrective pressures toward the 80 or 68.47 level with interim support at 68.83. Finally, I want to take a look at the dollar versus yen. Because this also is affected by economic data and was able to move back higher after the industrial production and capacity utilization numbers earlier this morning in the U.S. And this trend line here, where we have a number of different support levels being held, broke through. The market was able to break through that level at 91.18, but we went down and found additional support at 91.07. You can see the number of different hourly bars. It stopped at the 91.07, which gave it good support down here. The better data came out, pushed the market back above this 18 level, and the market has been, had a modest rise to the upside. There is a good resistance at the 91.52 level. That's where the 100 and 200 hour moving average come into play. But largely, the dollar yen has been in a very narrow range. You could probably say most of the activity over the last 10 days has been between 91.07 and 91.86. That's only 79 pips in the dollar versus yen. Normally when that happens, we look for a trend type move either to the upside or to the downside, but we're going to have to break through this 07 level, get through the 84 level on the downside. On the upside, if we get above these two moving averages right here, we're going to have to break above the 86 level and then above the 92.09 level to push the market. But this level right here in between the two moving averages converge here. That's 100 and 200 hour moving average are going to be our bullish bearish borderline. If the market can stay below that level, then we should see lower prices in the dollar versus yen. If the market is able to squeeze back above that level, we should see higher prices in the dollar yen. And usually, when the longer the market non-trends, the better chance of a trend. So we are still anticipating a trend, looking for a trend. We just have to follow the clues that the market's going to give us, that the market price is going to give us. This is Greg Michalowski with a look at some of the risk currency pairs for FX Street.